I am Suresh Kumar and this video is on Income Tax Act. We already had two videos on the same subject covering chapter 1 the preliminary and chapter 2 basis of charges. In chapter 1 we have gone through some of the important definitions. Chapter 2 we have gone through the provisions of section 4, section 5, 6, 7, 8 and 9. Now this video is on, actually it is not on chapter 3. Chapter 3 of income tax is exempt income, that is income which do not form part of total income. Most of the provisions of this chapter will be coming in the other heads of income. In this video, we are beginning with the provisions of chapter 4, and chapter 4 of Income Tax Act is the computation of total income. Chapter 4, computation of total income. What is the importance of this chapter? We may just consider section 4 and 5. Section 4 is the charging section, that is the basis of tax. In section 4, it is provided that a person is liable to pay tax on his total income. And tax is normally understood as it is levied. What is levied? It is assessed, imposed and collected. How it is assessed? That is what is computation of total income. Section 4 gives you that the liability to tax is on total income. Therefore, the assessee is liable to compute his total income and the tax is ascertained on total income. And section 5 gives you the computation of total income, that is scope of total income. We already discussed the provision in the previous chapter. There are two subsections, that is how to compute the total income of residents and how to compute the total income of non-residents. In computation of total income, what is given under chapter 4, it is from section 14 to section 59. Section 14 is the classification and section 15 to 59 is the quantification based on the classification given under section 14. Now computation of total income. Section 5 gives you the way to compute total income, and it is a mandatory provision which provides that the income shall be computed according to the provisions of income tax. Now just go through the definition given under 80B for gross total income, which is the total income computed according to the provisions of income tax before giving effect to chapter 6A deduction. And just recollect the definition of total income as given under section 2 subsection 45. It provides that the total income means the total income computed according to section 5, which is the scope of total income, and scope of total income gives you or provides that the total income shall be computed according to the provisions of income tax. As I told you in the previous videos, the income tax, the assessment has two parts. One is computation of total income, that is computational part, and other one is the procedural part, that is administration and collection procedure. The computational part is given up to section 89 subsection 1, that is relief. That is arranged in a special way. Just we may go through the provisions or arrangement of that chapter. That is chapter 3 is the exempt income which do not form part of total income. There are a list of incomes which are not liable to taxation. Some income are totally exempt and others are partially exempt. The details are given under chapter 3. income which do not form part of total income. That is, this chapter gives you a list of exempt income. Then chapter 4 gives you the way income is computed. It is computed, or the income shall be computed under 5 heads of income. One is chapter 4 and the subchapter A. Chapter 4A, salaries. How to compute the salary income of the person. Then how to compute chapter 4C, that is section 22 to 27. Salary is given under section 15 to 70. That is 15, 16 and 17 are provision to compute the salary income. Then chapter 4C, please note that there is no chapter 4B, which is completely omitted. In chapter 4C, it is income from house property. That is section 22 to 27. If the assessee has rental income, how it is computed for tax purpose. Then chapter 4D, it is from section 28 to 44 DB, and it is profits and gains of business or profession. How to compute the business income of the assessee, or if the person or assessee is carrying on profession, how to compute his income from profession. Then chapter 4E, it is from section 45 to 55A, capital gains, and the last one for chapter 4F, it is income from other sources, section 56 to 59. All these 5 heads are nothing but classification of heads of income for the purpose of computation of total income. What is total income? It is the total income liable to tax. Then after this chapter 4, there is chapter 5, income of other person included in the assessee's total income, section 60 to 65. Example, suppose a minor is earning income, how to tax? Normally, we will study later, it will be clubbed. It is the clubbing provision. It is clubbed with the income of the parent. And we will study the conditions under this chapter, chapter 5, 62, section 60 to 65. Then what is the relevance of aggregation of income? Chapter 6, there are 2 topics. One is aggregation of income and set off or carry forward for losses. Income Tax Act gives the assessee some benefits on the losses incurred by him, and the losses incurred by him can be set off against the income. And what is aggregation of income? It is the way of finding the total income. That is, the first case, we are classifying the income, thereafter we are aggregating the income. Why? Because income tax is one tax, that is total tax on total income. Income tax is one tax that is paid or assessed on total income. And for the purpose of computation of total income, we are classifying it to salary, house property, etc. That is, the assessee is not paying tax separately on salaries, separately on property income, separately on business income, separately on capital gains, separately on other sources income. All these should be aggregated. That is the relevance of the definition total income. Section 5 gives you total income is the total income computed according to the provisions of income tax. And when the income is classified into 5 heads, it is only for computational purpose and it is not for paying tax separately. That is why it is said that income tax is a one tax which is payable on total income. And total income can be computed by aggregating the income, net income computed under salaries, house property, business income, capital gains, other sources. And thereafter, deduction, chapter 6a deductions, it is from section 80A to 80U. At this level, you should understand what is the difference between exemptions and deductions. These chapters, there is income which is not forming part of total income, which is known as exempt income. Exempt income is not included in any of the heads of income. Now what about deductions? Deductions are the deductions allowed on gross total income. That is, gross total income under section 80 capital B, gross total income means the total income computed according to the provisions of income tax before giving effect to chapter 6a deductions. That is, when chapter 6a deductions are allowed on gross total income, you will get total income, and that is what is taxable under section 4. Section 5, which is the scope of total income, provides that the total income shall be computed according to the provisions of income tax. And chapter 4 of Income Tax Act gives you the way how the total income is computed. And chapter 4 is from section 14 to 59. And the first section in chapter 4, which is section 14, is classification of heads of income, which is provided as, this section provides that, section 14 provides that it is the heads of income save as otherwise provided by this act. All income shall be classified under the following heads. It is, all income shall be classified. For what? For the purpose of charge of income tax and computation of total income. What is charge of income tax? Section 4 gives you the charge of income tax, and the tax is paid on total income. That is the relevance of this section 14. This is merely a classification for the purpose of section 4 and section 5. What is section 4? Charge, for the purpose of charge. And what is section 5? How to compute total income. That is, section 14 specifically classify the heads of income for the purpose of computation of total income. What is required under section 5? That is scope of total income. That is, you should understand the arrangement of provision as section 80B defines gross total income. Section 2 subsection 45 defines total income, and section 4 is the charge of total income. Section 5 is the scope of total income. Section 14 is classification of heads of income for the purpose of computation of total income. And now section 15 to 59 is the quantification. That is the way we are compute the total. That is, you should understand this section 14 is only a classification, and this classification is for the purpose of section 4 and section 5. What is section 4? Charge on income tax, and section 5 how to compute income tax. That is, for the purpose of section 5, the assessee must classify. Why it is must? Because it is a mandatory provision. The word used is shall. The word used in section 14, shall, is mandatory. That is, for the purpose of computing the total income, which is required under section 5, for which tax is paid by the assessee. The assessee shall classify the income under 5 heads. These are all chapter 4A, salaries, and in chapter 4A salaries we are covering section 15, 16 and 17. Chapter 4C, income from house property. In between there is no chapter 4B. I already told you that it is completely omitted. Now chapter 4C is income from house property. There we will study the provisions of section 22 to section 27. Later we will go through profits and gains of business or profession. And then capital gains, section 45 to 55A, and the last one, income from other sources, section 56 to 59. That is, for the purpose of computation of total income, the income shall be classified. Income shall be classified into 5 heads of income. Salary income, that is income from employment. Then house property income, that is if the assessee has some building which is meant for letting out, how to compute the rental income. Then profits and gains of business or profession. Then capital gains, income from other sources. You should understand these are only mandatory classification which will help the assessee to compute his total income. Section 14A, expenditure incurred in relation to income not includable in total income. What is income not includable in total income? That is exempt income. That is, if the assessee has exempt income and if he is incurring any expenditure on realization of such income, such expenditure shall not be allowed as a deduction in computing the total income of the assessee. This is an extensive provision. Definitely we will consider this provision after studying section, the last proviso, that is section 59. Now chapter 4A, salaries. In chapter 4A, we are covering section 15, that is chargeability of salary. Section 16, what deductions are permitted under the head salaries. Then 17 is on some specific definitions. There are some specific definitions under 17. 17.1 gives you the definition of salaries. 72, definition of perquisites, that also included in salaries, and 73 is the definition of profit in lieu of salaries. Now section 15 gives you the chargeability of salary. What is taxable as salary? Section 15 provides that the following income shall be chargeable to income tax under the head salaries. There are 3 subclauses. What is taxable is any salary in subclause 1 and any salary in subclause 2 and any arrears of salary, they are also salary. That is, by reading section 15, it is clear that what is taxable is salary. What is taxable is salary, and this salary is defined under section 17.1. After this provision, we will go to section 17.1 to understand what is the meaning of salary. That is, what is taxable is salary. Any salary due from an employer or former employer to the assessee, that is employee, in the previous year, whether paid or not. Any salary due. How salary is realized by the employee?
salary accrues day by day and it is due on the last day of the month and is paid in the next month. And what is taxable? It is either due or paid. Salary due or paid. That is, in the letter we will go to explanation 1. If salary is taxed on due basis, it will not again be taxed on receipt basis. Therefore, you should understand the salary due or received, whichever is earlier, is the chargeability. Second provision, any salary paid or allowed to the employee, allowed to him means the employee in the previous year by or on behalf of the employer or former employer, though not due before it, not due or before it become due to him. That is, if the salary is paid in advance, then also it is taxable on receipt basis. Even if it is not due. For example, if the salary for the month of April is already received, that is received as an advance salary in the month of March, it will be taxed in the month of March itself. Therefore, if it is an advance salary, it is taxable as salary. First case, due or received. Second case, advance salary. And in the third case, it is given that arrears of salary also charged. That is, if the salary arrear is paid during the previous year, salary of any earlier year is not paid, which is paid during the current previous year, then it is taxable in the current previous year as the salary income of the assessor. Now, you should understand this provision of section 15, any salary due or paid or any advance salary, though it is not due, or arrear salary, which is taxable as salary. There are two explanations given to section 15. Explanation 1. If advance salary is included in the total income for any previous year, it shall not again be included in the total income on due basis. That is, there is a principle in taxation, no income shall be taxed twice. And section 15 gives you the chargeability as the salary due or received, whichever is earlier, is taxed with tax. If it is taxed on a receipt basis, it will not again be taxed on due basis. The same principle we already discussed under section 5, scope of total income. That is, there should not be any double taxation of a single receipt. There is another explanation, salary, bonus, commission, remuneration to partners from the firm is not salary income of the partner. In section 15, it is clearly states that the salary received by the employee from the employer is taxable. In order to attract the chargeability under section 15, this relationship should be there. That is employer-employee relationship. In the case of partnership, the partners are not the employees of the firm, partnership firm. Therefore, any income received by the partner from the firm as salary, bonus, commission, remuneration, etc. are not taxable as salary income, but it will be considered as income under the head profits and gains of business or profession. Now, let's consider the condition to tax the salary in the hands of the employee. You will be able to understand the meaning of employer-employee relationship.
there should be the relationship of employer and employee with respect to the payer and the receiver of income. The employee is under the control and supervision of the employer. It is contract of service. There are two services considered at this level. It is contract of service, which is employment, and there is another contract, it is the contract for service. The contract for service is not employment. There is contractor and contractor relationship. In the case of contract for service, the contractor is no way under the control and supervision of the contractee, whereas in the case of employment, the employee is under the control and supervision of the employer. Now section 17.1. Actually section 17.1, 17 subsection 1, 17 subsection 2 and 17 subsection 3 are all definition for salaries. And 17.1 is the basic definition for salary. Why is such a definition? Because we already have gone through section 15. And section 15 gives you the chargeability, and what is chargeable is the salary. Now you should understand the meaning of the term salary, and that salary is defined under section 17 subsection 1. It is defined in an inclusive manner. What is provided? 17.1 salary is defined, and it is given that for the purpose of section 15 and section 16. Section 15 is the charging provision for salaries, and under section 16 we will go through it later. It gives you some deduction from salaries, deduction permitted under the head salaries, and salary includes these items. Salary includes wages, second one any annuity or pension, any gratuity, any fees, commission, perquisites, or profit in lieu of or in addition to salary or wages. Profit in lieu of or in addition to any salary or wages, any advance of salary, then leave encashment, annual accretion to recognized provident fund, and the provident fund includes employees' contribution and employees' contribution, interest on employees' contribution, interest on employees' contribution. Now what is considered as salary? Employees' contribution in excess of 12% of salary, interest credited to the recognized provident fund in excess of 9.5% of per annum, and the transferred balance from unrecognized provident fund, URPF, unrecognized provident fund, to recognized provident fund. This contribution by the central government or employer as specified under section 80 CCD. This provision we will study under deductions under chapter 6A in the last sessions of this computation part. Salary is defined to include wages. What is the meaning? Salary is defined to include wages. What is the difference between salary and wages? Actually, there are some difference between the salary and wages in the language of accountants. However, for the purpose of taxation, income tax, there is no such distinction. Even if the employee is receiving wages, the nomenclature is wages, it is taxable as salary. Second one, any annuity or pension. Annuity means any annual sum given to the employee for the services rendered. Pension is the amount received after the retirement of the employee. Therefore, annuity or pension is considered as salary. Any gratuity? Normally it is according to the Payment of Gratuity Act, where the employee completed continuous service for 5 years is eligible for gratuity. Then if the employee is receiving gratuity, that gratuity is taxable as salary. Any fees, commission, perquisites or profit in lieu of or in addition to salary or wages. Any fees, commission, there are cases where the employee is receiving commission. It is not the commission given to some agents or other person, it is the commission given to the employee. If the commission is given to the employee, it is salary income. Commission, perquisites. Perquisites is separately defined under section 17 subsection 2. And this perquisites is included as salary for the purpose of income tax. Profit in lieu of salary. This is another definition given under section 17 subsection 3. 17 subsection 3 defines profit in lieu of salary. That is profit in lieu of or in addition to any salary or wages. Then any advance of salary. There can be advance of salary and advance against salary. Any advance of salary. Advance of, there is some difference between advance of salary and advance against salary. Advance of salary is salary, that is where the employee is receiving the salary for some other months as advance salary, then it is salary income. But there are situations where the employer is providing loan to the employee as an advance. If it is loan, advance against salary is loan and it is not not included as salary under section 17(1). Leave encashment. That is, each employer is providing the leave facility to the employee. The employee has two options: either avail the leave or encash the leave. There are situations when the employee is encashing the leave, which is known as leave encashment. In such a case, it is included as salary under section 17(1). Then annual accretion to recognized provident fund. What is a recognized provident fund? It is the provident fund recognized by Commissioner of Income Tax. In the case of recognized provident fund, what are the constituents of this provident fund? There can be, that we will discuss later, there can be employees' contribution, then employees' contribution, then interest on employees' contribution, then interest on employees' contribution. Employees' contribution is eligible for Chapter 6 deductions. Employees' contribution is to some extent it is chargeable under section 17(1) as salary. Employees' contribution in excess of 12% of salary. Employees' contribution, that is up to 12% of salary, it is not considered for taxation purpose. Any amount in excess of 12% of salary, that is annual accretion to recognized provident fund. With respect to employees' contribution, which is in excess of 12% of salary, is 17(1) salary. It is taken for the purpose of chargeability under section 15. Then interest credited to the recognized provident fund account balance in excess of 9.5% per annum is taxable. That is up to 9.5% it is not taxable, and beyond which it is taxable as 17(1) salaries. And transferred balance from unrecognized provident fund to recognized provident fund. Recognized provident fund is that one which is recognized under Income Tax Act for different purposes, and others are unrecognized provident fund. And if there is a transfer, for an example, suppose an employer is having some unrecognized provident fund, later the balance of the unrecognized provident fund is transferred to recognized provident fund, then it is salary under section 17(1) for the purpose of chargeability, that is section 50. And one more item, the amount specified under section 80 CCD. Section 80 capitals CCD is part of chapter 6A deduction that we will consider under that respective chapter. Now section 17 subsection 3, profit in lieu of salary. It is in an inclusive manner. 17(3) defined to include profit in lieu of salary, the amount of any compensation received by an assessee, that is employee, from his employer or former employer at or in connection with the termination of his employment or modification of terms and conditions relating to the employer. That is, in the case the service of the employee is terminated, actually the employee is losing his employment and it is the compensation for such loss, and the amount paid on termination of employment of the employee is profit in lieu of salary. If an item is profit in lieu of salary, it is included under 17(1) as salary. That is, any amount included under 17(3) profit in lieu of salary is automatically included under 17(1) salary. Why? Because salary under 17 subsection 1 define salary to include profit in lieu of salary. And modification, if there is modification of terms and conditions of employment, then it is profit in lieu of salary. The other provisions of this 17(3), any payment due to or received by the assessee from his employer or former employer from provident fund or other fund is profit in lieu of salary. Payment under Keyman insurance policy. We already discussed Keyman insurance policy. Keyman insurance policy is the life insurance policy on the life of some key personality of the company. The maturity proceeds under Keyman insurance policy is received either by the employee or by the business or by a third person. If the maturity proceeds of the Keyman insurance policy is received by the employee himself, it is 17 subsection 3 profit in lieu of salary. If it is profit in lieu of salary, it is salary under 17(1), 17 subsection 1. Therefore, any amount received under Keyman insurance policy is taxable as profit in lieu of salary if it is received by the employee, and any amount due to or received before is joining the employment. Normally it is termed as joining bonus. If the employer is giving the employee some lump sum amount to join with his organization, it is joining bonus, which is profit in lieu of salary under section 17(3). If it is 17(3), then it is automatically tax salary under 17 subsection 1, or it is after the cessation of his employment. That is, after the service is completed and the employee is receiving any amount from the employer, such amount is profit in lieu of salary. And any amount
received by the employee from the employer is also included under 17.3 as profit in lieu of salary. In the case of salary, the taxability is given under section 15. Under section 15 there are three subclauses that we already have gone through it. And what is taxable under section 15? It is salary. And that salary is defined under section 17.1, 17.2 and 17.3. 17.1 defines salary, and that salary includes perquisites, that is defined under section 17 subsection 2, but we will do 17 subsection 2 later, valuation of perquisite, and 17 subsection 3, profit in lieu of salary. That is 17 subsection 1, 17 subsection 2 and 17 subsection 3 are various definition for salaries. It is salary, perquisites and profit in lieu of salary. Now back to section 15, which is the chargeability of salary income. Section 15 includes, or the chargeability shall be on salary for the previous year, either due or received, and advance salary, that is the salary of the next period, and arrear salary, salary relating to the earlier period. That is salary or advance salary or arrear salary, whatever either due or received during the previous year is taxable as salary. That is why it is given as any amount due to or received by the employee from the employer, which can be included under section 17 subsection 1 as salary, is taxable or chargeable as salary. That is any amount due to or received by the employee from the employer, which can be included under section 17.1 as salary, is taxable. That is, in order to tax any amount under section 15 as salary, two conditions must be satisfied. There must be employer and employee relationship between the payer and the receiver, and the amount received shall be included under 17.1 as salary. If these two conditions are cumulatively satisfied, any amount received by the employee from the employer is chargeable as salary, subject to various exemptions given under various provisions of chapter 3, income which do not form part of total.